Financial model for early stage companies, you're going to find, you're going to notice that I rarely use the term forecast or forecasting. That instead you're going to see the term modeling, and that is quite honestly, you'll probably hear me say this again. I don't think anybody can forecast who isn't a prophet, and the time of prophecy passed a long time ago. So we're going to talk about financial modeling for early stage companies, primarily for the purpose of being able to provide your financial model to potential investors, but also to give you a tool for managing your business. So why do you need a financial model? Investors want to see one. They want to understand the value of what they're getting. Every investor, even quote unquote high risk venture investors, are risk averse. They want to maximize the return, but also minimize the risk. And your job as an entrepreneur, as a business person, is to appeal to their greed and to minimize their fear. And so what do investors fear the most? Normally, if we were live in a room, I would go around the room and call on some people, and usually get lots of answers like, well, they're afraid of losing their money, or they're afraid of making a bad investment, or they're afraid of having to explain to their investors why things went south. And the truth of the matter is, that's not what they're afraid of, because they understand that they're taking a risk, and they understand that they could lose their money, and they don't expect to earn a high return on every single investment. What they do fear the most is you, the entrepreneur. The biggest risk that any investor, any sophisticated investor, is making is the risk of investing in individuals who are not going to be able to execute. They're not going to be able to do what they believe they're going to do what they say they're going to do. Len, isn't it true that for, I don't know, for decades, if not generations, that VCs have been saying we bet on the jockey, not on the horse?
That is absolutely correct.
So everything in your presentation ultimately should speak to you and your ability as a business person to bring value to the enterprise. And if Lisa Tsu raises her hand, let her chime in, because this is her area of expertise, pitching to investors. At the end of the day, yes, you have to explain that there's a market and there's a need and there's value of what you're providing, but more than anything else, it's about you. And that's what the financial model is about also. So, who do you conduct business with? In an organization that I'm involved in, Provisors, we say you conduct business with people who you know, who you like, who you trust, and ultimately it's the people who you're investing in, right? So you and your financial model, therefore, have to demonstrate that you can be trusted, that you know how to put together a model, and that what's in that model is based on verified information and honest information, right? Your financial model must demonstrate that you understand business in general, that you understand how your actions drive dollars and cents through the business, that you know your specific business model, not just business in general, but that you understand what it is that your business is going to do, or at least based on reasonable assumptions, based on what you plan to do, and that you know how to make money, because at the end of the day, investors want to make money, and they want to know that you know how to make it, okay? And finally, that you know how to execute. Therefore, your financial model really has to speak to the execution of your business. And all of this will become much more clear as we move along. Are there any questions at this point? Len, anybody have a hand raised?
I don't see any hand raised. And actually, if people use chat to let me know that you want to have a question, I'll respond that way. It's probably easier.
Okay, great. So the goals of your investor pitch are to build confidence. Remember, this is about you. To demonstrate credibility, to create trust, to show how you can make money. And here's a quote from a past president of Tech Coast Angels. Business plans are seldom required or seen, but I do expect to see a financial model. The reason is, while the actual rarely meets the forecast, there's that F word, the assumptions that underlie the forecast model tells me a lot about whether the team understands the market and its business. Again, it's about you. So let's be honest, no matter what, any financial forecast will be wrong, and investors will come up with their own numbers. And I like to tell people that nobody has a crystal ball. And if you do, if you have a crystal ball that actually works, please email me because I'd like to make an investment. but nobody does, and no one's come up with one yet. And financial forecasting is an oxymoron. You cannot accurately forecast your financial results, but you can forecast what you plan to do. And that's the underlying starting point of your financial model. If I'm an investor and I want to learn about whether or not I should be making an investment in you and your company, then I want more than anything else to know, what are your plans? How are you going to drive customers? How are you going to bring your product to market? What do you believe are going to be the results of your actions? And that's where we start with a financial model. Again, and I apologize if some of this is repetitive, but I think it's worth repeating. The purpose of your financial model is to demonstrate your understanding of business. Most people think it's to show the value of the company, and therefore, if I can show you a model that has $100 million in revenues in 3 or 4 years, then that's what determines the value. But no, not really. It's really to demonstrate your understanding of business, to test your assumptions, to show how you plan to execute, and to estimate how much cash you need, because every activity that you put in your model is going to have, along with it, a cash requirement, whether it's hiring people or taking on space or advertising or attending a trade show, whatever, all of your actions are going to have some cost associated with them, and your financial model will tell you how much cash you need based on those activities. Determine how much you can afford to spend, because the assumptions about the money that's coming in will give you an idea how much you can afford, and it will share your financial vision. So, I've said that the forecast itself is not really key. However, if I'm an investor and you're an entrepreneur raising money, I want to know what you're thinking. I want to know where your head's at. So your financial vision will come through the model. If it's done in the right way, and if it's done, honestly, then it tells me where you think you're going to go. In some ways, if the financial vision is too high or too crazy, I might think, I don't want to get in bed with this particular entrepreneur because it's too risky. They don't have he or she doesn't have a clue as to what's realistic. In other cases, if the financial vision isn't significant enough, then I might look at it and say, there's not enough here for a reasonable financial return, and looks more like a lifestyle business than something that is worthwhile to invest in. And ultimately, to support, but not make your case for your valuation. The case for valuation is really going to be, you know, how you know, who your customers are and what the value is to them, and you know, what the competitive landscape is, and ultimately things like the experience of the management team and you know, what your track record is like. Okay, again, to repeat, the goal of your model is to build confidence, to demonstrate credibility, to create trust, and to show how you can make money. Your model has to tell a story. It's not just about the business. It's about you. It's not just about the formulas. It's about your actions. It's not about the results. It's about how you affect the results. And it's all ultimately about the story. So, what does this mean? It means we don't start with a revenue forecast. We start with a plan of action. We start with a rollout plan. We start with a marketing plan. We start with a hiring plan. And then we build on top of that in assumptions about how those are going to generate revenues. Before you can determine revenues and costs, you must forecast, or I should model, the activities and the timing considerations that drive those revenues. Identify the partnerships that are required to build value. Know your necessary resources, and derive reasonable cause and effect assumptions that derive revenues. So, for example, there are statistics out there as to, you know, how many clicks can result in a certain number of placements of ads. If you place online ads, what is going to be the number of people reading it? What is going to be the click through? What is going to be the conversion rate? You know, you basically take a building block approach to saying, okay, I'm going to spend X dollars on ads in a certain place, either online or in a magazine, and based on average statistics, those dollars, those ads are going to generate X number of leads or click-throughs. Based on reasonable assumptions, those click-throughs are going to result in X percentage of subscribers or users. And then, you know, if you have a model that, you know, where subscribers, some become paid, some become not paid, then you show the percentage that become paid subscribers. And then you also show the percentage of renewals. And so all of those elements go into the model to show how you get ultimately to a revenue stream. You know, who's going to buy your product or service? How much are they going to buy? You know, what is the average sale per customer? How much are they going to pay for? You know, what is a reason? Show the actual per unit cost of a subscription or a product. And how are you going to use your MVP to learn? Because, you know, ultimately, if you're going to have a minimum viable product, the purpose of that is to get feedback. So, you know, if you're going to come out with an MVP at a certain point in time, how much lead time or time beyond that do you need to build into your model before you actually know enough that you can come out with a product that customers will actually be able to benefit from and want to pay for? So all of these things, all of these timing lags should be taken into account. Any questions here or comments?
I'm not seeing anybody, so.
So I'm basically putting everyone to sleep is what you're saying.
No.
A nap is a good thing. Okay, so know your business model.
Someone just said, no, this is great. So you're getting good feedback here.
All right, that's fantastic. How will you make money? How do you plan to grow your company? What are your customer segments? Where are they located geographically? Are you going to be selling directly to consumers? You're going to be selling through channels. What are your value propositions? These are all things that ultimately will drive your decision of how to go to market. And we don't address all these specifically in the financial model, but you have to have these laid out before you dive into the model. And again, I think Lisa would probably agree with me, or educate me otherwise. But you need to know who your marketing verticals and your channels. What are your customer relationships? Are they going to be? Are you going to be dealing with executives? You're going to be dealing with managers. You're going to be dealing with franchise owners, or you're going to be dealing directly with consumers. And what are the various revenue streams? And those should be modeled separately. If you have multiple go-to-market methods, I mean, suppose you're going to sell some product online, direct to consumer. You're going to sell some product to stores. You're going to have different pricing. You're going to have different margins, and it's important to model those separately. And by doing that, by modeling them separately, you're showing your investor that that you understand. That, it would be very easy just to say, okay, I'm going to sell glass frames at an average price of $40 a piece, and I'm going to sell those glass frames to a whole bunch of people, and then just going to multiply them all by $40 a piece. But maybe some of them are going to be sold direct to consumer, and some of them are going to be sold, at $40 a piece. Some are going to be sold to opticians at places like Costco Optical at $20 a piece. And it's important to show those different streams separately, because again, it demonstrates that you understand your business and how you're going to go to market. So have all that nailed down before you start putting together a financial model. Okay, rules for financial modeling. Your model has to be credible, based on external constraints, internal constraints, and investor expectations and skepticism. And I'm going to talk about each of those. What are the external constraints? The external constraints are the number of potential end users, the competition, quote unquote, size of the market, ability to get raw materials if you're in a manufacturing business. I mean, right now I'm in a business where, actually, as a matter of fact, you can see I'm in a business environment right now. This company is an essential business. It manufactures ultraviolet germicidal devices that go into the air handling unit and literally kill microorganisms that get sucked out of the air and pass over their germicidal lamps. They're on the front lines of this coronavirus, and their sales have tripled overnight. Their sales orders have tripled overnight. Actually tripled last month. It's going to quadruple this month. However, they're getting power supplies from China, and they can't triple the amount of power supplies that are coming in overnight to meet the demand. Now they're ramping up, and it's going to take some time, but that's an external constraint. They can only sell as much as they get raw materials parts for, and so what a lot of entrepreneurs over the years have done that is really a mistake is they say, okay, the market is this big, and I can grow my business to meet that demand without any consideration for what's required in order to meet that demand. And it's not just about getting sales orders and customers, right? So you have to take that into account. There's also internal constraints. If you're in a business that requires you to hire people in order to scale, if it requires space, if it requires employees, it requires, it's just because the orders are there and the demand is there. Now, obviously, a lot of online businesses don't have a lot of internal constraints, but you need to be able to show that you can only grow as fast as your ability to hire and train people, your ability to put infrastructure and systems in place. Just because the demand is there doesn't mean that the sales will be there. So all that has to be taken into account when putting together a financial model in order for it to be credible. And at the end of the day, if you put together a financial model that no one is going to believe, you're just wasting credibility. You're making yourself look silly. And if the purpose is to build confidence and trust that you are the kind of person that I want to write a check to, then why would you want to make yourself look silly? I remember years ago, oh my God, this was before the dot-com boom. This was, well before mobile phones. I was in a pitch competition up in Santa Barbara, and somebody came with a with a deck that said they were going to do $1 billion in revenues in 3 years. And again, these kind of unicorns didn't exist back then. And I looked at this person and said, why are you going to do $1 billion in sales in 3 years when no one else has ever done that? He said, well, the market is this and nobody else is doing it. And all the justification. I said, excuse me, you cannot grow a business that quickly. Even if the market's an infinite, you just can't do it. And all you're doing is making yourself look silly. And so if you put together a model that is well beyond the expectations of anybody who's going to look at it, and you're just creating more investor skepticism, why do it? Scale it back. It's got to be realistic. It's got to be credible. And you know what? If you do what you think you're going to do and you exceed your projections, then you're just going to end up being a hero anyway. So why waste that credibility on a model that no one's going to believe anyway? So be realistic and run it by some people with experience. Your model has to be supportable, based on detail, based on outside benchmarks. And if we have some time at the end of this webinar, I'm going to show you some samples of some models that I've used, that I put together for the purposes of this course, that show that there's a hiring plan, and it shows who's going to be hired, when, how much each one is going to be paid. Salaries should be based on what is typically paid for people in those roles. Rent should be calculated based on what is the market rate in wherever it is you're going to be renting space. Everything should be based on specific detail and, like I said, outside verifiable benchmarks, because that's where you get your credibility. When you're pulling numbers out of the air, they're easy to challenge, they're easy to shoot down, and hard to justify and defend. So you always want your model to be defensible. And again, I know I sound like a broken record here, but it should tell the business story based on your actions. Putting the model together. Follow convention. This is, at the end of the day, it still is accounting, and it's pretty simple. You need to have a standard income statement, a standard cash forecast or cash flow statement, a standard balance sheet. You're not going to get you know, points for artistic creativity. Uh, so, you know, if you follow convention, it shows that you know what you're doing. Don't use a template. Now, a lot of people will disagree with me with this. I, I believe that you should develop your own model. It should be tailored to your own business. You know, I like Excel. I've never seen a standard, you know, template program that does as good a job. Yeah, it's more work, but it's, you know, each business is unique, and you know, I think that you also, the other problem with using a template is that it confines you to that model, and it keeps you from putting into your model those things that are unique and special to your, you know, your own approach to business. A bottom-up detailed approach. Top-down models. What's a top-down model? A top-down model is, okay, sales are X, G&A is going to be 7% of X, selling and marketing expenses are going to be 14% of X, and R&D is going to be 10% of X, and we'll just use that as a basic assumption. That's not how you build a business. You don't grow a business by saying, okay, I'm going to spend 10% on sales and marketing. You grow a business by specifically taking out ads, hiring salespeople, paying commissions. And so if you take a top-down approach, applying just global percentages to your sales, it's just going to be real obvious to the sophisticated eye that you haven't done your homework. So everything should be based on a bottom-up approach. Nothing is more embarrassing than to provide a financial model to an investor and have them, A, not have a clue what you're doing, or B, find errors in your model. So a lot of the way I recommend that you put together a model is really quite simple. It's sophisticated, but it's not complex. Do not use a lot of worksheets or tabs in your model. Every time you add a tab, you have to link that tab to other tabs in your your model. And I've seen financial models that have 20, 25, 30 different tabs, one for each year, one for sales for each year, one for expenses for each year, one for what you're creating with that is an absolute nightmare. If you look at my models that we'll look at the end of this webinar, you'll see basically 3 tabs for inputting information. One for revenues, cost of revenues. Len, you raise your hand. And you're muted. Len, you're muted. You're muted.
Sorry about that.
Did you want to say something?
No, not at all. I was just testing the raise your hand.
Okay. So what happens is I have one tab for the entire period that's being modeled for revenues and direct cost of revenues. So it's revenues, cost of sales, commissions, royalties, anything that has to do that is driven directly from revenues is all in one tab. It's all in one spreadsheet. You don't have to go back and forth and back and forth. By the way, nothing is more annoying than having to deal with hidden tabs in a spreadsheet that you forget are there. You don't have to go back and forth. It's a lot easier to navigate up and down within a single spreadsheet than it is to keep going back and forth and back and forth. So I have one for revenues and direct costs. I have one for everything that's related to staffing and headcount, which includes also capital expenditures, because a lot of capital is based on the number of people you hire. All of the rent calculations are in the headcount tab. So there's one for revenues and costs, one for headcount and related costs, and then there's one more for all the other operating expenses. So that's 3 tabs. And then there's another one for the monthly financials, but there's almost no input in that. That's just a roll up of the other 3 tabs. And then I have another one for annual financials, so you can easily copy and paste it into a deck. I'll show you that. Drivers or assumptions. For years, I've heard that you need to put all your assumptions in one place, and I've seen models that have a separate tab for assumptions. I cannot disagree more. I believe that all of the drivers should be right next to the numbers that they drive. So if you have a line for a particular revenue stream, what should be at the and constantly visible to the left side of that revenue stream, the average unit price and all the assumptions that drive that. So when you make the change, you see the changes. You don't have to go back to the assumption page and then go back to, to the revenues to see this change. You should be able to see all of the changes of all the assumptions in real time. So you should avoid the temptation to have all your assumptions in one place. It's much better to have them right next to the numbers that they impact. I guess there's still no questions. Okay.
No questions. I haven't. You're getting comments saying you're doing a great job. So.
Well, okay, that's great. Would you save all those comments so I can forward them to my wife later?
I'll figure out a way to do that.
Okay, putting together the model continued. Be granular. More detail is better, not worse. Change and shade inputs, data inputs, and not formulas. Now, some of this is just what I would call spreadsheet modeling work habits. Your investors aren't going to care that much if you shade the data inputs and not the formulas. But what I do, and I've learned a long time ago, that all of my cells that have formulas are white. And on a subconscious as well as a conscious level, I never write over those fields. So I never screw up my formulas. I only have where information can be changed in fields that are colored. So that's a really good habit to get into. And I've seen other people do the same thing. Don't ignore the cash flow implications. Revenues don't always generate cash in the same time period. Expenses don't always use cash in the same time period. You're going to need to have an income statement that is basically done under general accepted accounting principles, or if you're calling in from, if you're zooming in from Europe, International Financial Reporting Standards, there is something called IFRS. It's similar to GAAP. None of you really needed to know that. The horizon should be 3 to 5 years or until exit. It really should be, the horizon should really be the horizon that's interesting to the investor. So, for example, if you are in a company, or have a company that is doing a new drug or some kind of medical testing or some device or something that is not likely to generate revenues, but is going to have to go through years of FDA testing, clinical tests, and your exit strategy is to be sold to a big pharmaceutical company. You would do a different kind of a model. I mean, you would basically show the costs and the milestones, and if it requires 17 years of clinical testing before you would be acquired, you would model it out for 17 years. I mean, that's not the case. I just threw a number out from the air. But if you really believe that this is something that's going to be flipped in a year or two, then you might not need to forecast or model it out more than a year or two. It's really should be focused on modeling to the point where the investor should expect to get their value. Forecast by month. And here's another situation where a lot of people disagree with me. For years, I saw, heard from people, do the first 12 months and then do the next 4 years as yearly periods, or do the first 12 months and then do the next 4 quarters and then by year. Here's the problem with that. When you try to transition a model, and you may have to trust me on this, I've been doing these kinds of financial models since 1982. I did my first model on an Apple II using VisiCalc on a computer that was that was owned by Jim Lally of Kleiner Perkins, Clawfield and Byers, who was a member of the board of directors of the company that I was working for at the time. And I learned something rather remarkable. When you try to transition from a monthly period to an annual period, or from a monthly period to a quarterly period, or quarterly period to an annual period, whoops, the formulas break down. That's number one. Number two is when you forecast annual periods, you lose the peaks and valleys from a cash flow standpoint. It may show that going from one year to the next, you're fine, but somewhere in between there, you might end up with with a cash dip that you didn't plan for. Ultimately, if you're going to do a 3-year plan, it should have 36 columns. If you're going to do a 5-year plan, it should have 60 columns. Every period should be identical to every other period in terms of time. You can replicate formulas. You can manage it more carefully. It may seem like a lot more work. It actually isn't. You'll spend more time trying to make the transition from a month to a year make sense than you will if you just model it out the full 60 months.
So Ellie, I'll ask the obvious question. Why not just do it for a year and then divide it by 12?
Well, because, I mean, yeah, that's a good question, Len, but that's not the way business has grown. I mean, I don't know anybody who isn't an extremely well-established non-seasonal business. By well-established, I mean years and many millions of dollars of sales, that can reasonably expect to have consistent monthly sales and expenses when they're starting a new business. Things change rapidly. If you're on a high growth trajectory, it's going to have, there are 2 reasons why companies run out of cash. One is really good and one is really bad. They run out of cash either because they're growing too fast and they don't have enough money to finance their receivables and inventory and capital equipment purchases that they need to support that growth. Or they run out of cash because their sales are going down and they're in trouble, right? You need to be able to know when you're expecting to run out of cash. And if you're just going to take an annual number and divide it by 12, that's just going to obscure that. It's also going to obscure your plan of execution. If you're an investor, Len, and I say, you know what, I just took the first year and divided by 12, how would you feel about putting money into my company?
I'm just asking because I think it's a shortcut that a lot of people will take
Yeah.
in order to get to a 60-month projection.
Yeah, it is. It is a shortcut.
So it's not something I'm recommending doing. I'm just pointing out, there are a lot of, as I work with a lot of startups, this is the last thing that they put together when I'm looking at, well, you got a really nice pitch deck, but where's the meat and potatoes behind it? And they don't have it. And this is the meat and potatoes behind it.
Right. And so if they're going to take an approach of taking 5 years and dividing each year by 12, the message that would send to me is you don't really know how to grow a business, and you really don't understand how things change from month to month. And if you're going to take a shortcut here, how do I know you're not going to take a shortcut somewhere else?
Absolutely.
So that's it.
That's why I asked the question.
Yeah. So So business is not about taking shortcuts. It's about careful planning. It's about making good decisions. It's about getting feedback from your markets and adjusting your plan accordingly. And so,
So Ellie, we have a question here. It says, how important for budget versus real? And is it important to match financial model with actual accounting when raising money? Should they be synced?
there are different philosophies on this, and it is a very good question. A budget is in a rapidly changing environment, and I'm going to give you my opinion, okay, and you'll get other opinions as well. In a rapidly changing environment, I find budgets to be fairly useless and constraining when it comes to making decisions, because I believe that decisions should always be made from here looking forward, and budgets are always looking back. A financial model for the purposes of raising funds is not the same as a budget. It's really basically just to say, here's what we plan to do, and where we're, you know, and what we believe are the financial results of those plans. Board members like to see budgets in a lot of times, and they like to see budget versus actual. And but here's the here's the joke, if you want to call it that. How many times have those of you who are on this call been in a situation where budgets got revised and then revised again and then revised again, so that by the end of the year you had 3 or 4 or 6 different versions of a budget, which means that the previous versions were all irrelevant in hindsight. I don't like budgets for companies that aren't well established. I don't like budgets for companies that aren't giving, using them to authorize expenditures for line level managers. That's not to say that they aren't useful. It's not to say they shouldn't be used. I'm just giving you my own. I'm really just giving you my own personal take on it. I find them to be more a waste of time than a value. I would rather always be looking forward. I would always rather be saying, okay, where are we today? What are the choices in front of us, and what is the expected return on those choices? That's not a budgetary exercise. I realize that in larger command and control organizations, where you want to give division managers and department managers some idea as to how much they're allowed to spend, that those budgets are valuable. And I know that there are people in this room that probably are going to disagree with what I just said about budgets. So
Ellie, we have a hand raised here. Mavis, you have a question?
Yeah, I have a question regarding what you said earlier, Ellie, about how the key driver assumption should be on separate page depending on where the cost or revenue are coming from. But wouldn't it be easier to run sensitivity analysis if all the assumptions are on one page together?
No, it's not, Mavis. You can, first of all, you can have, there are a lot of different assumptions about costs and revenues and hiring dates. And if you can't see the change immediately from those assumptions, then it's an inefficient process. Now, one of the things that I like to do is put a single switch in the annual financial summary, where I'll have, and it's less than perfect because things don't change that easily. But like, for example, I'll have a field that says 100%, and I'll change that to 90%, and I'll have all of the revenues and variable costs tied to that field. And you can change that from 100 to 95 to 90 to 80 to 125, and see all the changes right there on the annual summary. That one cell does not need to be on its own page. things like average unit price, like percentage of commission, commission percentage, like royalty percentage. There's no reason why those should be in a separate location when you can put them right next to the royalty line or the commission line or the revenue line, and see the changes right then and there. If you prefer to do it that way, you can. It just, most of the people that I've worked over the years really like the idea that they can see the drivers and the results of those drivers all together in one place. And by the way, what I do is on my sheets, I use the freeze panes so the drivers are always visible. So even as you move across the page from month 1 to month 60, and those months get, the earlier months get obscured, the drivers are always visible. Mavis has her hand raised again.
No, that makes a lot.
I think you just muted her.
Oh, sorry. Is that okay? Can you
Yes.
hear me? Okay. Yeah, no, thank you so much. I think that makes a lot of sense. Another question about what you said about med device is really, I think it's very insightful. How do you think is the best way to model the cost and milestone, given the fact that, a class 2 med device would take at least 5 to 7 years? Even if I exit, it will take some time. What do you think is the ideal way to showcase execution ability in that case?
Well, you would have, if you're going through clinical trials, or you're going through that kind of, some kind of an FDA required process, you really need to give, your best job of trying to figure out who you need to hire as researcher. I have a client who's actually a pharmaceutical company, and he went to an outside clinical trials research company, and he got estimates from them. He got bids from them, and we just put that all into a model, and assumed that the milestones would be what this company, this outside company that has that expertise said they would be. If you need to hire researchers, if you need to hire engineers, you would build those into your model, and you just look. You have to have a plan, and that plan starts with those milestones and what you expect. How long they're going to be and how much they're going to cost, and what you expect to have at the end of those time periods. So anyway, I think. Let's move on. Review and test. One of the things that is good to build into your model are some test lines to make sure that the formulas are working properly. I like to have metrics on various expenses. I like to make sure that, like, for example, that your assets equal your liabilities and shareholders' equity, and if there's a line in there just to, if anything is other than 0, that means that something has to be fixed. It's important to make sure that your model's working.
We have another hand raised here.
We sure do. Brenda.
As soon as I figure out how to unmute her.
Yes, thank you. I was challenged with the platform here. Eli, thanks for organizing this, or Len and Eli for providing the training. Yeah, so I lead an enterprise SaaS company. We have annual licenses, a couple multi-year. We are going into growth stage. So with the current environment, and actually in previous businesses I've been in, I usually like to have best case, base case financial plan, worst case, and kind of if somebody throws $1 million or $2 million at you, how fast could you grow? do you have experience with multiple, I guess, scenario?
Yes, yes. Actually, I very recently put together a model that had a base case and it had two other scenarios. And what I did is I created on the revenue spreadsheet a matrix where it had which, you know, the three different cases and the inputs for each of those three cases. And then I used a lookup formula.
Mm-hmm.
And there was one field where you could choose, there was a drop box and you would choose which case.
Mm-hmm.
And then the lookup formula drove all of the all the drivers up and down that spreadsheet.
Right.
And so you would just click on which case you wanted and it would just explode through the model. Again, that was all done where the information was that those things were driving, as opposed to having it on a separate page.
Right.
But,
I can
yeah, no,
investors right now are going to be asking for these different scenarios, particularly with what's going down, right? So.
Yeah. Well, look, for any of you who are Stubbs, Preccelerator, cohort companies, either current cohort or past cohort,
Mm-hmm.
I do have office hours the third Tuesday of every month, and just because I'm not physically there doesn't mean I'm not willing to spend time with you. And so, you know, I know that, you know, Bennett Heems, who's on this call, I mentioned that too, and we're going to be getting together one of these days. But yeah, no, if you want to spend some time with me offline, just let Len know, and
I'll do that because we are actually a client of Stubbs, so I'll send Linda.
good enough for me.
Yeah, super.
Thanks, Brenda. I look forward to getting that.
Okay. I do have to drop, but thank you very much.
Okay,
All right, bye-bye.
So segment your markets, you know, whether individual consumers, businesses, channel partners, size and demographics. Each of these segments you would want to model separately because they all have their own unique pricing. They have their own unique go-to-market strategy. And again, that shows that you know what you plan to do and that you have an understanding of your business, and it'll show your sophistication. Inputs, the activities that drive revenues, customer acquisition and retention, sales team, advertising, promotion. I'm just going to go through this real quickly. Content development, content delivery, customer support. You don't forget to include that. Business development, partner development. All of these are expense items that you should be modeling separately to the extent that any of them are applicable to your business. How will your pricing be defined and quantified for each revenue source? What is the price per unit? Is it a subscription model? Is it a transaction model or a fee for service? You know, is there going to be some, you know, one-time setup fee or non-recurring revenue customization that you're going to be charging? Again, it's not just one line for revenues. It's everything that you plan to do.
So, Ellie, could you spend just 2 seconds talking about pricing? Because I think a lot of times we get people who just are throwing darts up against the wall for pricing.
Yeah, well, you know what?
And that's a whole nother workshop, by the way. So you don't have to get into
it. It sure is. And if you know Per Sociers, he'd be a good person to do that.
Or talk to him about it.
So, yeah, pricing is, it's a little bit art, it's a little bit science, a little bit math, magic, and a little bit just dumb luck. A good place to start is to see what other people are charging, other companies are charging for similar products and services. You really always have to take in two key elements, which is, you know, one, what are customers willing to pay? And two, is there enough margin? Because if they're not willing to pay more than what's going to cost you, then you don't have a viable business.
That's good. I just think it's something that people need to pay a little bit more attention to than just throwing a price in there.
Well, no, they do. And it's, I think, just to repeat what I just said, it's really important to know what the cost of each customer transaction is, because Um, you know, the old saying, you know, I lose money on every sale, but I make it up in volume. It's, you know, it's not the way it is in real life. In real life, you know, you have to be able to, you need to know your cost of each sale, and that's the direct cost, whether it's a royalty or materials and labor, the you know the customer acquisition cost. You know, what is it? You know, what do you have to pay in terms of you know, commissions, or take your, you know, your total sales salaries and divide that over, you know, the number of units. And your pricing has to, and this is really important, your pricing can't just cover the cost of the sale. It has to cover the cost of your overhead and your back office and your, you know, administrative and your executives and you know, at the end, at the end of the, I keep saying at the end of the day, I have to stop saying that. You're in business to make money. And so, yeah, in the beginning, you're probably not going to make money, and, you know, your sales may not result in covering all of your fixed administrative and overhead and research costs. Eventually, you have to get there. If you don't know how to put together a break-even model, that's something you should learn. Break-even model tells you at what level of revenues you cover all of your fixed costs, and you're at zero profit for the entire enterprise.
And that leads to a comment that Andreas just wrote. It's important to differentiate fixed versus variable expenses.
Yes, it is. It is.
Yeah.
And by the way, fixed costs can be variable over a longer period of time. So, for example, your monthly rent is a fixed cost. However, when you've reached your capacity and need to grow beyond your capacity, your rent goes up. So a lot of times your fixed costs are really step function costs. You need to take that into account as well. Here are examples of your direct costs: labor, material to produce a product, royalties, commissions. Even though commissions are considered to be a sales and marketing expense, they are a direct cost of revenues. Your staffing and related costs tend to be fixed over short periods of time. Product design, and things like legal and accounting and insurance, all those need to be taken into account. Here we go: monthly overhead, insurance, legal, rent, utilities, etc. Those should all be separately identified in your model. Your startup and other capital expenditures, employee furniture and equipment, server equipment, software build. These are things that you may have to just spend a lot of money up front. They will get amortized over the life of their use. Those also need to be taken into account. I often get this question, and the reason why I put this as a question is because I get this question from people who are in these workshops. Why do I need a balance sheet? Isn't it good enough just to provide a statement that shows how much money I'm making and how much cash? Well, balance sheet does two really important things. Actually, three really important things. The first thing is that it shows that you understand finance, because it's a key statement. It shows the differences between income and cash flow. A lot of times what happens is you spend money on things that end up on the balance sheet that don't necessarily come out of profit. For example, your inventory. For example, you know, if you're selling on credit, you may have an asset called accounts receivable that doesn't turn into cash until you collect it. The one thing, the hidden secret to why the balance sheet is important is because it will uncover errors in your underlying income and cash flow model. For example, if you have a balance sheet that's showing your accounts receivable going through the roof or going negative, you can't have negative accounts receivable, then that means that there's an error in your cash flow model, right? A lot of times people won't see that without a balance sheet. The balance sheet, your inventory and your receivables and your payables should scale at a reasonable rate to your business. They should never go negative. The same is true for other assets and liabilities. So the balance sheet is not just important, it's critical, it's necessary. And so if you're asking the question, why do you need a balance sheet? There's your answer. If you're still asking the question, why do you need a balance sheet, then you're probably not ready to be a business person. That sounds pretty harsh, doesn't it? So that's why.
It's amazing to me how many people who are, quote, running a business who don't know how to read a balance sheet or don't pay attention to it.
Well, you've got to pay attention to it. And by the way, and this is not about business modeling, but you know, I get into a lot of, you know, engagements where I'm brought in as an outside CFO, where people don't not only know how to read a balance sheet, they don't even know what's in their balance sheet. One of the disciplines that I strongly recommend that you sit down with whoever your controller or accounting manager or CFO or whoever's doing, you know, your accounting, that they reconcile every balance sheet account every month so that you can look at that number and ask the question, okay, what makes up my fixed assets? What makes up these deposits? What makes up the prepaid expenses? If they can't provide you a detailed listing of everything that makes those up, then you don't have a balance sheet that you can have confidence in. It's really critical to have you know, monthly reconciliations, not just of the bank accounts, but of every account on your balance sheet. You should be able to look at an accounts receivable listing and add that up, and the total should be exactly what's on the balance sheet. It's an important discipline that I strongly recommend to everybody who's in this room who's got their own business.
Ellie, just giving you, we're at about 15 minutes here.
Okay, so we're at the end, pretty much at the end of the PowerPoint. So I'll wrap this up and bring some examples. Don't use tables in your presentation. If you're presenting a deck, you never want to have a slide that your audience needs to study, because you'll lose their attention. And at the end of the day, I said that again, you do want your presentation to be a communication between you and your investor, and the focus should be on you. So this will basically just take them away from you, and they won't be listening to you anymore. This is the proper way in a presentation, or you know, with some other kind of a chart, to present numbers, because they can see very quickly where you start, where you finish. There's nothing to study here. So I strongly recommend using charts and not tables. And that's the PowerPoint. Now what I can do is, we can take some questions, but let me just show you a financial model. Let's see.
A template.
Well, no, this is not a template. This is a teaching tool. Okay. You'll notice that that I've got all the tabs are visible. This one I don't even want to show you. Get rid of it. Don't read that first. That's just a disclaimer that basically says that I own this model.
All we see right now is the PowerPoint.
Oh, you see the PowerPoint?
Yeah.
Well, we're going to have to new share. Thank you. There we go.
There you are.
So what I was saying, here you can see that there is a 60-month model here, and all of the assumptions in column A, B, and C remain visible. This is a simple, just to give an example, model. What I would normally do is have your sales drivers up here and have those drive the units using some basic assumptions. This is actually kind of an old model. You can see here the price per unit is $3,500 times 10 units for that month. If we change the price per unit to $5,500, you see all the changes. So you can work with the assumptions and see the results of those assumptions all in one place. You know, service revenues is going to be 12% of sales. Boom. So I'm going to show you a couple of things that I recommend strongly to everyone who's using Excel. The first one is go to your options, go to your advanced options, and you will see that there is a box that says allow editing directly in cells. Microsoft delivers Excel with that box checked. I'm going to tell you to uncheck it, because when you check it, if you don't uncheck it, whenever you double click on a cell, it just shows you the formula, but you already have the formula up here. You don't need it there. When you uncheck that, you create for yourself a significant navigation tool. So always, and if you do this one time, you'll never have to do it again. Allow editing directly in cells. Unclick it and watch what happens. When you click on a cell, on any cell, when you double click it, it shows you what makes up that cell. And you can go back very quickly. So here's the annual income statement. I want to see where the total revenues come from. If you double click on that, boom, it just took you back to the monthly financials. If I double click on that, and there's your 99,977,000. If I double click on that, it shows the 12 months that makes up. And if I double click on this, it'll take me back to the source. So that's number one. Number two is, a lot of people say, well, hold on a second. If you were to type in, whoops, $5,500 per unit, you would get that. So how did you do that? If I learned one thing from my days at Arthur Andersen back in the late 70s, it's the importance of having good documentation so that the model tells its own story. The way you do this, and this is the only other Excel trick I'm going to show you, is if you click on number formatting and use the custom formatting, anything that you put in there in quotes will display but not be part of the value of the cell. So this has per unit in quotes. You can see that the value of the cell is strictly $5,500, but it says here it's $5,500 per unit. Here I've got 0% of base, 12% of sales, 100% of plan. And all of that becomes beautifully self-documented. This is the question, by the way, that I don't remember if it was Brenda or Mavis that had this question on what if you want to look at a different case. In this particular model, I've got something called 100% of plan, and every one of these cells is reading that cell as well as these. And you can see again, the inputs are all shaded and the formulas are in white, as I said earlier. If we change this to 90%, watch what happens. So you can do a 90% of plan or an 80% of plan or 120% plan and do some what if scenarios there. It's not perfect because it only changes the variable costs and revenues, but you can do that. So you'll see that we've got the different types of revenue. The total revenues are, in month one are 61,600. You'll see that again, 60 months right across. At the very end, I've got annual summaries so that it can be rolled up, and we can double check what the annual numbers are. We can see what the impact of changing this from 5,500 to 10,500 is on the annual numbers. So you can see all the changes right there as you make the changes of the assumptions. I've got the material cost per unit, same basic approach. I've got commissions, in this case, 12% of revenue, maybe it's only be 5% of revenue. Every time anybody sees this model, it's different than the previous class because I change the stuff on the fly. And then I've got an inventory forecast. And again, this is all still in the revenue and cost tab because revenue, cost, and inventory is all related to each other. In this particular case, I've got, for each line item, a beginning inventory, what needs to be purchased, total cost of goods sold. The cost of goods sold is from above, and the ending inventory. And then the purchases use a formula. Well, hold on a second. That was the annual one. So let's take a look here. The purchases in this particular model looks at the current month and the next month need, and that's how it comes up with 125,000. Which is, current month cost of goods sold, the next month cost of goods sold, and then basically you have to figure out in your own business what, how much stock you need to have on hand and what you need to cover. So then it adds the purchases, subtracts the cost of goods sold, and gives you the ending revenue, ending inventory, which is the beginning inventory for the next month. And then it's all summarized. And you can see that this is product 1 plus product 2 plus product 3. Why is this important? Because you have to pay for inventory whether you sell it or not. And so that all goes into that. So
you have a question from Lisa?
Yes, Lisa, I figured we'd get a question for you eventually. How are you, Lisa?
I'm good. I am not holding it against you that you're wearing Giants gear as you're giving this presentation. It was super helpful, Ellie. Really got a lot out of it. I have a general question for you because,
yes,
at least for me, I'm working with founders who clearly are having to rethink their models in light of the pandemic. And of course, none of us had a black swan event built into our assumptions.
Yeah.
As they're trying to rethink their models at this point, do you have any general advice for questions they should be asking themselves as they're thinking about their models now?
Yeah, the first thing they should be asking themselves is, what if I can't get the money that I was planning to raise because investors are going to go into a hole for 3 to 6 months? What do I need to do to survive? Because look, you've been around, you know what happened in 1987 and you know what happened in 2008 and the money dried up, and in some cases it was 12 to 18 months, and then it opened up with a the window opened up like crazy because there was all that pent up demand because at the end, because venture capitalists and angel investors have to put their capital to use. So that's the first thing, is that what are you going to do to survive without outside capital? That may be the only key question. I mean, and the next thing is what do you think that is going to be different in the post-COVID world? I mean, like, in some cases we have no clue. In some cases we can get an idea. I think that, to give examples that probably don't apply directly to any of the founders that you're working with, but there's some analogies. If you were in commercial real estate and you were leasing office space, can you imagine that the demand for office space is going to be the same as it was before? It's now that people are discovering that they can get by with Zoom and Ring Central, and they don't have to waste all that time on the road, and they can be just as productive at home. The business that I'm at here today, you know, right now we're going through a crazy time because everyone wants sterile air, sterile zone, sterile UVD units to prevent the spread of viruses in their buildings. But will that demand still be there at the, you know, when this is all over? What I've been telling my client is you need to change your marketing focus, and you need to change it now, because the message is no longer energy savings and healthy building. The message now is preparedness. Because once this is all over, people aren't going to feel, you know, the same urgency to put sterile air units in their buildings unless they're scared about the next one. The one thing that we've learned is that this has caught us all off guard. So you, sterile air, need to change your marketing message so that, you know, it says to the world, do you want this to happen to you again? What are you going to do next time? And so for all your founders, they need to be thinking about their messaging. That's not a financial modeling question, but it's,
Right.
you know, the key is what is their message going to be now and as we come out of this to remain relevant in a new world. And I think those are the two things that you know, that I would focus on the most. You know, you know, try to anticipate how this is going to impact their business and their go-to-market strategy. And in some cases, they're going to have to pivot. In some cases, they're going to have to, you know, maybe their business isn't going to be viable anymore. Maybe, you know, I mean, I know I have a client who's in the cosmetics business who basically what she's doing now is her cosmetics business is closed down, but she found an opportunity to make and sell masks. And so she's completely pivoted overnight into a mask business because she happens to have a connection to, you know, over in China, and is able to get masks in large volumes. So those are the kinds of things. And look, like I said at the very beginning of this, no one has a crystal ball. But if you ever needed to try to look into the future and figure out what it's going to look like, now's the time to do it.